There's a reason most crypto trading bots eventually fail, and it's not because automation doesn't work. It's because almost all of them are built on the same flawed premise that one strategy can survive every coin, every volatility profile, and every market cycle. That assumption sounds reasonable at first, until you test it properly. And when we did, the results weren't subtle. In fact, on the same coin, under the same historical data, two different parameter structures produced a huge performance gap. And today, I'm going to break down exactly how BitsTurtle was engineered to close that gap, step by step, so you can see why most bots plateau and why this system behaves differently. But to understand the optimization layer, we have to start before optimization even begins. Layer 1. Structural filtering. Most bots treat the market as a flat field. If it's tradable, it's usable. We don't. Before strategy generation, the system filters roughly 90% of available coins. Not based on hype, not based on trend strength. Based on structural stability, it comes down to three core filters. Market capitalization. Here's the problem. If you go too high, like Bitcoin or Ethereum, yes, they're stable, but the return potential is build imitant. If you go too low, you might see impressive charts, but those coins can use 90% of their value overnight, or disappear entirely. We target the sweet spot, coins with enough market cap to be stable and liquid, but small enough to deliver meaningful returns. Minimum age requirements. New coins are unpredictable because they don't have enough behavioral data. No history means no pattern, and no pattern means no reliable strategy. We only consider coins that have survived multiple market cycles, so we're working with assets that have proven they can exist long-term. Volume consistency and exchange credibility. If a coin trades on sketchy exchanges or has erratic volume spikes, that's a red flag. We need consistent liquidity and legitimate exchange support. Because here's something most people overlook. No amount of strategy optimization can compensate for structurally unstable assets. Layer 2. Mass parameter testing. Let's say a coin passes that filter. What most bots would do next is apply a preset configuration. Maybe they offer 3 profiles: conservative, balanced, aggressive. But underneath, it's still a static structure. We took a different route. The system generates and tests thousands of parameter combinations. We're not talking about cosmetic tweaks. These are real structural differences that change how the strategy behaves. Things like, how aggressively does it buy when price drops? At what point does it take profit? How much capital does it risk per position? How does it adjust position size based on market conditions? Every one of these variables creates a completely different performance profile. But here's where it gets complicated. These variables don't work in isolation. They affect each other. If you change when the bot buys more during a dip, that changes how much money is at risk. If you change when it takes profit, that changes how long your money stays locked in a trade. If you adjust how much capital you use, that changes how fast your returns compound. So you can't just pick random settings and hope they work together. Most bots don't account for this. They give you 3 preset modes and assume one size fits all. But BitsTurtle doesn't guess. The system tests thousands of combinations for each coin to find the configuration that actually works. Not just the one that looks good on paper, but the one that survives real market conditions with controlled risk and consistent compounding growth. That's the difference. Now, testing thousands of configurations sounds impressive, but there's a problem most people don't think about. Just because a strategy looks good in testing doesn't mean it'll work in the real world. That's where Layer 3 comes in. Layer 3. Full cycle validation. A strategy that looks amazing during a bull market proves nothing. The real test is, what happens when the market turns? Because here's what we found when we ran these thousands of configurations through real historical data. The majority of them, snapshot vibes, lose money long term, but only a tiny fraction can maintain steady growth while keeping losses controlled across all market conditions. That's what the system looks for. Not the flashiest short-term gains, not the most aggressive returns. The configuration that balances 3 things: consistent returns, controlled drawdown, and the ability to survive when markets get ugly. So each selected configuration is backtested across full historical cycles, including bull and bear markets, sideways contraction phases, and everything. If performance collapses under stress, it's removed. Only strategies that hold up across every market environment move forward. And this isn't a one-time process. The testing, validation, and optimization runs continuously in the background. So as markets evolve and new data comes in, the strategies stay current, not locked into what worked 2 years ago. Now at this point, most systems would stop, but this is where we added something that fundamentally changes portfolio behavior. Layer 4, the recovery mode. Most bots rely on stop-loss logic. It's simple. If price drops beyond X%, exit. Loss realized. Move on. That approach limits your downside, but it also locks in losses. We built something different. Here's how it works. 9 of them are doing well and making profits. One position hits a rough patch. The price dropped hard and now it's constant deep in the red. Most bots would just cut that loss and move on. But recovery mode asks a different question. What if we use some of the profits from those 9 winning trades to help fix the struggling one? The system takes a small portion of your realized gains and uses it to improve that losing position. It partially closes the position, then re-enters at a better price. This lowers your average entry point. So now, instead of needing the price to bounce all the way back to break even, you only need a smaller recovery / close it profitably. You're not taking on more risk. You're using profits you already made to give that position a better chance to recover. And it happens automatically. No emotions, no hesitation, just smart portfolio management. So that's the 4-layer system. But here's the thing. All of that is useless if it doesn't execute properly in real time. Which brings us to the final piece. Layer 5, live execution. This is where theory meets reality. The system runs 24/7, monitoring markets and scoring every eligible coin based on probability. When conditions align, it executes automatically. To 10 positions running at once, each with its own coin-specific strategy that was optimized and validated through everything that we just covered. No panic decisions at 2 a.m. No second guessing whether to take profit or hold. No emotional overrides that wreck your strategy. Just disciplined execution based on data. And here's what matters to you. Your funds never leave your exchange. The system connects through API. It can only trade, not withdraw. You set your allocation, and the system handles the rest. That's the full system. So what does that actually mean for you? It means consistent monthly returns, historically averaging up to 10% per month, with automatic compounding that grows your portfolio without you touching a thing. It runs 24/7 while you sleep, work, or live your life. This isn't some get-rich-quick scheme. It's systematic wealth building on autopilot. So when people say trading bots don't work, what they usually mean is that preset bots don't adapt. They don't filter coins properly, they don't optimize strategies at scale, they don't validate across different market cycles, and they definitely don't manage recovery at the portfolio level. The problem was never automation itself. It was static, one-size-fits-all architecture. BitsTurtle was built to solve that exact problem by making the entire system dynamic, from coin selection to strategy optimization to live execution. Now, if you want to see this in action, the actual optimization logs, strategy selection data, how your portfolio is performing, there's a free trial link below. I'm not asking you to just trust what I'm saying. Run it yourself, study the data, see how it behaves with your own allocation. Because once you actually see the system working, the difference between basic automation and intelligent automation becomes pretty obvious.